And we're back with Investment 360. Now, according to Herschel Jawitz, CEO of Jawitz Properties, the residential market will remain much the same for the remainder of the year, as well as the first 6 months of 2015. Jawitz joins us now for a look at what that could mean for your investments. Herschel, thank you for making the time to join us. So why no change? We're seeing a sluggish economy. We're in an upward interest rate cycle, and yet you expect that much of the same.
So the conditions, those exact conditions, slowing economy and rising interest rates, is what we've seen for the first 8 months of this year. In fact, started at the end of last year. And yet, despite these factors, we're seeing relatively strong demand in the residential property market, shortage of stock, banks gradually continuing to ease their lending criteria, and as a result we're seeing much better than expected price growth, especially in your major metro areas, Johannesburg, Cape Town, Durban and Pretoria, and I expect those conditions to continue through the remainder of this year and into 2015.
Which is backed up, Herschel, by an article in Business Day a couple of days ago. It says here the residential property market has experienced a rapid, or rather a dramatic improvement over the past 18 months. I don't know about dramatic, but anyway, with prices stabilising, it says, and buyers having easier access to financing. A couple of the points that you just brought up. Real estate agencies believe the market has moved back to pre-recession levels, with houses being sold far more quickly than they were in 2008, 2009. So not just the prices, these things come onto the market and get shifted quicker than they were being.
Absolutely, and you know, it's been driven by two factors. I think we're seeing, as I mentioned earlier, much stronger buyer demand. I think there's a lot of pent-up demand coming back into the market. A lot of buyers are back into the market who were held out of the market either through bank lending or through financial circumstances. So that's on the demand side, and I think on the supply side we're seeing, and in some respects, a critical shortage of stock in the marketplace. If you look at, never mind what's happening to property prices, but the volume of sales that are taking place, for example, in Johannesburg, from where they were in the peak, they've probably clawed back maybe 20 or 30% of them, but are still probably 40% below where they were at the height of the market in 2007. And as a result, we're seeing buyers more urgent. We're seeing buyers having, for the first time, a fear of loss. And we're seeing faster offers, provided obviously that properties are priced right, which is always the common denominator.
Herschel, when you look at the property market, I mean, a little bit of a history lesson which you know well. No one wanted to touch properties late 90s, early 2000s. It was just an awful asset class. Then all of a sudden it just got going like crazy. I mean, housing prices must have gone up, what, 350% from 2001 to 2007, 2008.
Yeah,
mortgage bond was growing at 25, 28%. The wheels fell off. We were lucky in South Africa, as you all know. We didn't really lose money.
No.
The house prices stayed more or less stable. They might have not matched inflation for a few years, but they stayed stable. So we didn't experience the dramatic collapse we had overseas, but there was a lot of empty units. Now, of course, no one built for 3 years.
Correct.
Is it actually recovering? So if you want to make a residential property investment and you want to look at it not the way you live, if you actually want to go and buy to rent, if you like to call it that, is this a good time to get in right now? Because there's clearly no bubble at the moment.
No, certainly not a price bubble. There's probably a small activity bubble, but from a yield point of view, I believe it's still a good time to invest. And what's happened over the last 5 to 6 years is that the rental market, A, because lots of buyers were kept out the market, didn't have enough deposits, couldn't afford to get in. B, a lot of the stock that was built in the boom of the market was that sectional title rental stock, very little new stock coming on. So what's happened is property prices have lagged, rental escalations have climbed, and so depending on which price segment you're in, but if you're looking at the sectional title market up to 1.5, 2 million, those yields in some cases are probably now around about 9 to 11%. It may not be what you can get in other markets like the equity market, but as part of a portfolio relative to the risk, a double-digit yield is not a bad return.
Now, when you look at the big players are getting into residential, the listed properties for the first time in, I think, since the Caller Drive estate collapse in 1969, the big players are getting into the residential market. Does this, what's the impact of this into the market?
So if you look at where they're getting into, it's quite interesting. It's not in your traditional, for example, Sandton townhouses. The one or two funds that are getting into the market are generally getting into your slightly riskier, higher yield properties. So, for example, the Johannesburg Greater CBD has become a part of listed funds. So I think, in part, I think it's potentially to balance the yields they're getting in the commercial sector. But I think what it is going to do is raise the profile of residential property and move it from not only an emotional roof over your head investment, but create some appetite and create some supply and demand from a real return point of view, and I think it's good for the market.
Herschel, what about low-income property in particular? I mean, you mentioned earlier that banks are likely to come to the party a little bit more in terms of mortgages, and one would think that that's an opportunity for them to capture clients. Do you see this as a potential way that investors could actually realize lots of value at the bottom of the, not necessarily at the very bottom of the pyramid, but low-income who are looking for mortgages from the banks?
So certainly from an investment point of view versus buy-to-live, the banks are still a little cautious and careful about that buy-to-let market. So getting mortgages on investment properties, second properties, getting mortgages on, for example, leisure coastal markets, are still on properties for holidays, are still more difficult than they are for your home that you're going to live in. But the appetite at that entry-level market is very, very strong. And in fact, the yields there are probably closer to 12 to 15%, provided that you can get the financing from the banks.
Provided you can get the finance from the bank. So everyone's watching what's going to happen on Thursday. In other words, the decision by the South African Reserve Bank's Monetary Policy Committee. I mean, if we go up another 25 basis points on top of the 75 basis points we've already had this year, some people will, even with just 25 basis points, will be knocked out of the market. So the nascent recovery in the market you've been talking about, in fact, that article I was reading from is attributed to you, then it immediately stops again. So it's very, very tight as to, it's very fragile, rather.
I think it is fragile. So I think there are three factors. You know, one is interest rates. So if you talk about a 0.25% on a R1 million bond, it's about 160 Rand a month in extra payments. On the top of the increases we've had, it starts to make a difference. But I think that just generally, if you look at where property prices are going, even at current interest rates, they're still relatively low by South African standards. Price growth is moving forward, but not at very high rates. It still is an attractive opportunity to buy, but I do think that first-time buyers market is where the pressure is going to get felt, and that's how markets recover from the bottom up.
Herschel, many years ago, everyone and their dog was selling this prime London flat to South African investors, and people truly got burnt on those. Now, at the moment, overseas yields on properties, now I'm talking specifically listed properties now, are about the same as ours, maybe a bit better. What's the state of the overseas property market in relation to our property market? Does it look good? Does it look bad? Has it, in fact, recovered from the collapse in 2007, 2008?
If you look at the UK market, you've probably got to distinguish between the London market specifically and the rest of the UK. I think that the rest of the UK is still lagging behind from a recovery point of view. The London market has probably recovered and made up more ground. So it still remains a very expensive investment. And the reason why they were investing then and wouldn't invest now is not so much the returns, but it really is a Rand hedge opportunity. Where I think that the real opportunity still lies from an investment point of view, but it's still a largely untapped market for South African investors is the US market. And there's still parts of that market, Florida, Arizona, Nevada, which are still way, way, way off the peaks that they were at the height of the market. It's just a little further from home, and I'm not sure that South Africans yet understand that market and have an appetite to invest in the US market.
Well, maybe taking a step away from the global markets and looking at the continent, when we talk about property, we often limit our conversations to retail expansion and retail property booming on the continent. To what extent would you see residential property maybe tracking that and obviously tracking some of the government priorities as governments across the continent seek to provide affordable housing for many of their populations? Do you see opportunity there at all?
I think there is, and I think, you know, one of your earlier guests mentioned that the untapped potential of Africa, and I think that includes residential property. You know, if you look in Southern Africa, you look at markets like Zambia, Namibia, very strong property growth, lots of development, and very similar to here, a shortage of stock, not only in the resale market rather, but also in providing for the unhoused. So lots of potential, but you've got to know what that local market is, because otherwise you can get burnt.
Lots of potential, but you could get burnt. That's it for Investment 360. A big thank you to Herschel Jawitz, CEO of Jawitz Properties, and our own Wayne McCurry from Momentum Wealth. After the break, you can catch hot stocks. But before we go, a quick one from me, Lindsay. Two things that stood out for me. The first of which was that response that we got with regards to comparing Anchor Capital to Coronation, saying that, well, maybe Anchor Capital doesn't have to try to be a Coronation whatsoever. And